We got to start with the. I keep calling it the backdrop to the trade, but that's what it is. And it's high energy prices. And it does seem like traders are looking beyond the war, yet it's hard for a lot of people to say there is a clear end to this. How are you looking at that?
Thanks for having me on, Tim and Carol. Well, we do a ton of research on energy. I founded an energy company, and our first ETF, AMZA, is a pipeline company. So we have a global supply and demand model. So the way we framed it is there's a good rule of thumb that works extraordinarily well, which is every million barrels of lost capacity is $5. So if you frame it that way, if the Strait was shut down forever, then the oil price would be about $140 a barrel.
Okay.
Because there's elasticities of demand or sensitivity and supply. And we started out roughly at 60, and so our point since the beginning of the war is that 100 is probably going to be an inflection point, because there's almost 100% certainty at some point the Strait will reopen. You essentially have every country in the world who wants to have it open. Now Iran, so we think that's a good strategy to blockade. Yeah. Probably not Russia, but that's not that important. So what we always try to do is look longer term. So at some point the Strait's going to be open. And so we're bullish long term, and we were bullish in mid-March because there's a cycle of fear and greed. So greed occurs during earnings season, like now, and fear occurs when there's no earnings, and you have hedge funds and other momentum investors typically overshorting stocks, like KKR, for instance, in our opinion.
Yeah.
And a lot of the tech companies. So that's why we all have jobs, is that you have these inefficiencies in the markets.
So you're saying, though, longer term, you assume this year that the Strait will reopen, and probably sooner rather than later, in your view, because Iran is feeling the pressure, the price. And even though we had an earlier guest who said they're used to an economy that's just decimated and having problems, and so maybe their threshold for pain is greater, there's a reality that they need the Strait open.
Absolutely. And the other Middle Eastern countries do. Pakistan wants it open. They're mediating. So we just try to stick to the most likely case and not all these outlier cases like, the Strait never reopens and we'll sell all of our stocks, and then you miss out on big rallies.
I think the concern for some people is the Strait opens, but Iran continues enriching uranium, and the U.S. and Israel don't want to see that happen.
Right.
So then you're sort of back to this, what you had before the war, yet the leadership in Iran has been decapitated by whatever measure you want to use. And that economy has been severely destroyed. And you have a military operation that has cost the U.S. untold hundreds of billions of dollars tens of billions of dollars at this point.
Well, the way we see it unfolding is we do think it's a good strategy to blockade the Strait. So we actually went long the futures when they were off 70 handles over the weekend. I think it was last weekend or the weekend before. But if that doesn't work, we think that the Strait will be reopened by force, possibly using ground troops.
Really?
So that there isn't going to be a case where the uranium still stays there, that will destroy their energy infrastructure, use ground troops, and just open it up.
So it escalates.
Right.
Before it ends.
Yeah, so that would be a negative inflection for the market. We kind of saw that yesterday,
How negative, though, and how long does it last?
Because of this target and the fundamentals, which we can get into, we think it'll be a pretty shallow dip, like it really was. Like actually March's activity in the stock market was super bullish, because that's the best you can do for a sell-off in the U.S. at least. Then that means that we're probably going to go higher when things settle down.
So that's why you're holding to that 8,000 target.
Well, actually, it's valuable to come on and do appearances, because I don't really always love doing appearances, so I try to have good data. So I use this thing, I don't know if you're aware of it, but it's called the Bloomberg Terminal. And you can get consensus.
Know it well and love it well.
Yeah, and it's sort of definitive because people like me use it. So, and there's a great function, SPX Index EEO Go, and I set it to annual. And I said, oh my God, of course we should do this more often. We based our 8,000 target on 350, and it's now 375, and you can even click on it. I'm doing that now. And you get this fabulous chart of what happened. And you see I guess it's the yellow line. No, it's the purple line. It just took off like a rocket. And so actually my 8,000 target is conservative based on our assumptions about interest rates. So at 375, if we get there, we're far away. Our target would go up to 8,600. Wow. So we think 8,000 is easy now, even at today's rates. And so it's critical to stay on top. And we do believe in consensus. We're not like a lot of strategists say, oh, well, we're bearish on earnings and we're going to haircut it. Like, that's the consensus. It's on the terminal. So what everybody's looking at.
So to be fair, it's earnings. It's fundamentally based. You're just looking at what the companies are doing. And as long as they are hitting these numbers, like, you can fundamentally trade on them. I mean, they're giving us when they give us an update, they're telling us how they feel and how they're doing against this macro war backdrop.
Absolutely. And that's why I said be focused on the long term, because those numbers are not only not going down, they're actually going up. So why should you sell your stocks because of the problems in the Middle East?
Go ahead.
Well,
please.
I
want to talk names.
Okay, we'll talk names and I think people would be listening to this or watching this and they're saying, wait a second, what about those higher energy prices flowing through and affecting earnings? Because it affects the top line if customers are paying more at the gas pump, and it affects the bottom line if these companies their inputs are more expensive.
Well, that would be a disaster if we're in Europe or Asia. But in the US, the energy prices have come down to only be 3% of consumer spending. Yeah. And we have free natural gas. I mean, I'm exaggerating, but it's nearly free natural gas.
Carol was looking at a chart earlier today.
Yeah, they actually go down when oil prices are higher because it's a waste product of drilling for oil.
It's a byproduct, right?
Right, and so it goes down. And that's the biggest advantage you could ever possibly create. This is why the notion that the U.S. has lost its exceptionalism is ridiculous, because you can't change history. We have all those hydrocarbons that came from the inland sea that used to be there.
It's not the 70s and we're in the oil lines because we're so dependent on oil outside the United States.
And one thing that almost nobody ever talks about, we had wage and price controls on the entire 70s, which I didn't even realize till recently, even though I was alive. But that was a disaster. Our production plummeted during the 70s. So, we obviously don't have that. So we have production. That's why it's only $5 per million, because we're going to produce more in the U.S.
So listen, we only have about 3 minutes left here. So you do speaking of the energy sector, you like Cheniere, ticker LNG. It's up about 32% year to date. It's going to report the first week of May. Why that name in particular?
Well, MLPs and infrastructure,
Master Limited Partnerships.
And pipelines are interesting because people kind of hate them.
Yeah.
Like, they never go up. They haven't gone up for 2 years. So you could say, oh, I don't want to go into these mo trades if we're correct about the war ending. But they're trading at really reasonable multiples. And they're going to benefit long term because actually the destruction of capacity is long term in the Middle East. So they have a great situation where everybody wants to source their natural gas now from the U.S., so they have a long-term advantage. So a good value stock, it'll come down when the war ends, but it's a great long-term investment.
You mentioned KKR earlier, so I want to give some time on your view on KKR, which is down 16% this year. There's some concerns when it comes to credit, when it comes to private equity.
And the firm has said that they've got limited exposure to private credit, but they have, limited some of their capped withdrawals on one of their asset-based finance funds because redemptions were above that.
Well, what happens in the market,
redemption requests were above
again, this is why we have jobs, is that people say, oh, alternative asset managers, they create a basket and they just short them every day, and KKR's in the basket. But they don't do any work and say, private credit's 15%, and it's probably the best or one of the two best financial services brands in the world. And that's important because they're going in and pitching to CalPERS. And, we could go pitch CalPERS on managing their money for 100 years and never get any money.
Yeah.
So there's only a few companies like that. So why should that trade at 10 times earnings? It's rallied, that's off the lows, but that should be a 20, 30 multiple company because they raised $23 billion last month during a terrible month. So that company's not going away. They have permanent capital and they have limited exposure. So we prefer that company to ones like Apollo that do have a lot of exposure to private credit.
I hate to do this, but we're going to do it. 30 seconds on Amazon, because you have said it is the poster child for the rotation being overdone. It does report next Wednesday, and it's up about 9% year to date, just quickly.
So quickly, Walmart trades at 43 times, Amazon at 22 times. Amazon
That's
grows
amazing.
over 20. And so you have a PEG ratio of 4 versus 1. I'll pick the PEG ratio of 1.